Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It is Wednesday, May 30th, 2018. We normally do this on a Tuesday, but given it was Memorial Day here in the States, we moved it a day later. Hope you had a very nice Memorial Day weekend. In the U.S., it's a way for us to pay tribute and thanks to our veterans. And I am the grandson of a war veteran, so it's a very important time to give thanks to them for what we have. And I think if you listened last week, you know that I had a quiet weekend. My wife and kids and some of our neighbors, the moms and kids, were down in Disney. And so I've had, this is now my fifth day of just my dog Annie and I hanging around the house. And after a lot of playoff hockey, playoff basketball, Major League Baseball to watch, you know what I realized? After about 36 hours, the house is awfully quiet. You know, the first 36 hours, you know, some of the guys come over, we have a few beers, we have a bourbon, we're sitting there watching sports, right? My kitchen looks a mess. I don't have to clean up the pizza boxes. I mean, for that first night, it's like, wow, look at this. And then, you know, right? It's not the same when they're not there. My dog, she was a wreck. She kept looking. We have a routine, right? So her routine was so thrown out of whack because my kids weren't there and my wife wasn't there, and she was stuck with me. And we get along well. Annie and I, we're pals, but she was moping around in the first day, right? So she didn't have that. Look at me, I'm a free guy for a few days attitude. It hit her immediately. For me, like I said, you know, a few Budweisers, some pizza, and some games, and I was good. And then on Saturday, I was all excited. I went out and have a power washer, and I brought all my patio furniture out from the garage, set everything up, power washed the deck, not the deck, but the patio. Got the back of the house, the windows, power washed everything. I like to do all the stuff myself. I hate bringing people in to do it just because I can. So if I can, why shouldn't I? Right? I also find I love to do it because it's good mentally for me. It clears my head. I'm doing something that's not sitting behind a desk. I'm not on a phone. I'm not reading a 10K. My head's not in a spreadsheet. So I love doing that stuff. Now I'm limited. I'm not that handy. I'm more of a grunt. So any grunt work I can do, and I enjoy it. Anything that requires mechanical ability, aptitude, vision to be able to build something, I'm a nightmare. I'm more of a takedown guy and a clean guy. But you know, you play to your strengths, right? So power washing for me is fun. Patio, go out in front, do the sidewalk. So all good. And by noon Friday, I'm done. Noon on Saturday, I got my honey-do list is completed. By that time, I had a couple of nights of beers and pizza. So now I realize, well, my structure is gone. And boy, I don't like this. So here I am texting and calling. And after a while, you know, when the kids are like, oh, yes, Dad, we're fine. We miss you too. Don't you have a game to watch? So anyway, they come back in a few hours. So I'm very excited about that. Besides that, my Mets are imploding. I can't even go there. But last night watched so it's today is Tuesday, the broadcast, Wednesday, the podcast. But last night was the first game of the Stanley Cup. And I'm watching it, and it's Vegas versus the Washington Capitals, and its first game is in Vegas. And I mean, it was appalling, the pregame. Sorry for those of you who love Vegas. Sorry, those of you who love theatrics. I'm going to piss half the people off in this podcast, but I'm an old school hockey guy, and to watch the pregame drama with characters on the ice portraying the Golden Knights versus the East, the Capitals, and the hype surrounding it. It was just, I mean, I was begging for it to stop. Are you kidding me, NHL? Really? Who are you trying to bring in? You have 31 or 32 cities, whatever you have. I think that's the number. And they're hockey towns, and that's where people love it, right? But you have a limited audience, right? It is the fourth sport, at least here in the U.S. Well, I mean, I love it, but who are you trying to bring in? It reminds me when you went back to I don't know, 15 years ago, and you had a little red flame around the puck when it went on the ice. I mean, stop with giving these people 30 minutes to do this ridiculous pregame. Right? That was 18,000 people in the arena. How many people know hockey? How many people are transient coming through? Anyone who's a hockey purist is watching this going, are you kidding me? Stop. Enough with the drama. Enough with the theatrics. Just play hockey. Play old school, hard-nosed hockey. That's what I want to see. That's what I think a lot of people want to see. I was getting texts. I was on Twitter. I mean, WTF. Seriously? Know your role, know who your audience is, right? Maybe you're going to get some hockey tourists in, maybe you get a little bit of ratings, but the ratings have to suck. They suck, and hockey is what it is. But for those who play, don't make the hair on the back of my neck stand up because I got to watch this ridiculous pregame. I mean, I don't know what control the NHL has over the Vegas Knights ownership in doing that. And maybe they're playing to their audience, but my God, to give them 27 minutes of a pregame, disgraceful. Absolutely disgraceful. Anyway, all right, I'm done with that. Last week in the markets were kind of flat, not much going on. I mean, I think the Dow was up 0.2%. The S&P was up 0.3%. NASDAQ again, tech-heavy NASDAQ up 1.1%. Right? So, and kind of weird when you think about it, last week, very positive note, you had Steve Mnuchin, the Treasury Secretary. I still can't say his name, but Mnuchin. He came out on Monday. I think he said last week, U.S.-China trade war has been put on hold. Right? We're continuing to work out our differences. So that was kind of good news, right? Now, if I'm not mistaken, weeks ago, if that had come out, the market would have erupted, right? Because that's why the market went down, right? That's what I remember. The bulls saying the market's down, only the trade war. So here, Mnuchin comes out and says, boop, on hold. We're going to work out the differences. And then China follows that up with a pledge on Tuesday saying it's cutting import tariffs on automobiles to 15% from 25%, and so on auto parts from 8 to 25% down to 6%. But didn't really have that much of an impact, right? Because then on Tuesday, Trump comes out and says, we haven't reached a deal with Beijing to save Chinese telecom company ZTE, right? So they've been really hurt by U.S. sanctions, and it's been kind of like a bargaining chip. And then on Friday, tentative deal reached on ZTE, but it was kind of too late for the market to move on that. Why? Because Trump canceled the June 12th summit with Kim Jong-un on Thursday, saying in an open letter to Kim, he felt the meeting was inappropriate because there was so much, quote, tremendous anger and open hostility displayed in a statement recently from a North Korean official, which was aimed at Vice President Pence. So you also then had on, I think it was Thursday. Yeah, it was Thursday that Trump signed the Dodd-Frank reform bill on Thursday, which rolls back regulations on small and medium-sized lenders, which was put in place post the 2008 financial crisis. So you have Chinese trade talks going on hold. You have Dodd-Frank being rolled back, which is a big deal for banks. And then, the imports get cut by the Chinese. So again, markets went nowhere. But again, that's the reason why all the bulls will tell you that was the focus of why the markets had been getting hammered over the last few months. And I mean, they've rallied a bit now, but so, one of the things that I want to talk about today, I'm bringing a guest on that I think is important. And it's early days, but I don't know how often many of you have Italy in your thoughts. Now, I'm an Italian American. My mother was the children of Italian American. My grandparents Italian American. But I don't know how often Italy is in your thought process in terms of investing. But it should be because there's a real anti-establishment populist movement that's taking place there. It's called the Five-Star Movement. And there's a new government trying to be formed. And Italian President Sergio Mattarella was going to decide on Sunday whether or not he was going to approve a new economy minister. And he rejected that. And we've seen Italian bonds sell off a great deal. And we're seeing people flocking to U.S. treasuries. And you say, well, what does that matter? Well, if I take you back to 2011, 2012, I think you'll remember Portugal, Greece, Spain, Italy, Southern Europe, ton of debt. And default rates were a concern. Italy's the third biggest economy in the Eurozone. And back then it was fear of who's going to get kicked out of the Eurozone. Lots changed over the last few years. And by the way, and we're going to talk with my guest about the impacts of that, so I'm not going to get too much into it now. But back then it was fear of who's going to get kicked out. Today there's a fear of who wants to leave with this rise of populism that's taking place, led by DJT, Donald J. Trump, right? You're starting to see it spread a little bit. And there are major implications for all of us if this continues. And there's a word you might remember from 5-6 years ago, maybe going back to the financial crisis, contagion, Contagion. And we're going to talk about what contagion is, how it forms, how it spreads, and what it means. So the Hedge Fund Corner, which I started last week, is going to really be a hedge fund interview corner this week, because I have on the podcast somebody I've known over 20 years, a very good friend of mine for 25 years, I think, at least over 20. He was a hedge fund analyst in the financial services area. He was one of 5 or 6 partners at my old hedge fund that we had. And he's probably the smartest analyst, pure analyst that I know. And his name is Barry Cohen, and he's going to come on and talk about the implications of this and how to look for it and what we should talk about. So I'm not going to waste any more time with ranting about hockey or talking about Trump and Kim Jong-un. We're going to get right into it with Barry Cohen. And we're going to start talking Italy, banks, and what you need to know. Barry Cohen, welcome to the podcast.
Thanks for having me, Mike.
So a lot going on, Barry, in financial markets land. And I was saying earlier in my introduction, I was talking about the Italian debt crisis, which we're going to touch upon, or potential crisis, and the Eurozone. But one of the things I mentioned in the opening was talking about how last week, President Trump signed the Dodd-Frank reform bill, which rolls back all these regulations on small and medium-sized lenders, which was put in place following the financial crisis of 2008. So for listeners, if you can, talk about pre-Dodd-Frank and what Dodd-Frank was and what the impact to banks was.
Sure. So before the financial crisis that started in late 2007 and then rolled through, for all intents and purposes, all the way through 2009 and even 2010. Financial services globally, but specifically in the United States, had for a couple of decades at that point gone through what is known as a deregulation. And so banks, after the Great Depression, were heavily regulated. There was a separation of investment banking from typical commercial activities, such as making loans or mortgages. Mortgage insurance was put in place, lending standards were put in place, reporting standards were put in place, minimum capital requirements were put in. There was a whole host of rules that came into effect over a long, long period of time after the 30s. Starting in the early 90s, what you started to see was a slow but steady unwinding of that, and nothing was more telling of the deregulation than the vast mergers and acquisition boom that started, really basically around 91 all the way through about 2000. I can remember being an analyst, and it almost feels as if like every week there was another deal. And some of them were what's known as serial acquirers, which means that like once they finish one, they start off on another. And
right.
And I can remember there used to be a very large banking concern down in the South called First Union, and First Union, almost on cue, made acquisitions once a year. And I can remember hearing a guy, Ed Crutchfield, who was the CEO at the time of that bank, saying, "I just kept on throwing billions of dollars down till he said yes." And of course, he was referring to a deal that he paid a very large premium for. And that was kind of the atmosphere. And a lot of that was driven by deregulation, and a lot of it was also driven by, how do we create more efficiencies in the banking system by taking out controls? Well, everybody was making more money than you could ever think of. The bankers were making money, the shareholders were making money, the lawyers were making money, and they wanted to keep that going. And when they want to keep that going, one of the favorite things to do is to spend money in Washington, because after all, lobbying actually, while very expensive, has a very, very, very high returns on the capital that you spend. And they lobbied for a lot of rules to be changed. And one of those rules
I find that shocking that spending money on politicians will get a high return.
I actually think
I'm joking.
Somebody should do a paper on this, but my guess is that political contributions are the highest rate of return out there of all investments you can make. Though I have no empirical evidence for that.
Right.
And one of the things that they did, if you remember back when Sandy Weil was leading the charge at Citi, was to basically unwind the separation of investment banking from commercial banking. And when that happened, it really set the stage in many ways for the crisis that we went through in 2007 and 2009. Lending standards went down. A lot of activity which normally banks would engage in and then keep on their balance sheet. So, like the word that's used in the industry would be inventory. So, like you could think of a loan the same way you would think of steel if you're making a car. Steel to an automobile manufacturer is their inventory, and that's the stuff that they make cars from and they sell. Well, if you're a bank, you don't really make anything. You produce loans, and that's your inventory. And historically, that inventory would sit on a bank's balance sheet, and people would pay their loans. Occasionally, you'd get into a recession, or people would get in trouble, and they'd have to work it out. And bankers would sit around the big mahogany table with a lot of paper and figure out like how to solve a problem. But when you brought in Wall Street into it, what you started seeing is a lot of traditional products that normally sat in inventory in a bank's balance sheet started to actually show up in the public capital market. So unlike bank loans, which again usually reside on a bank's balance sheet, bonds, or at that point, the nascent beginning of what we now call securitization, which I'm sure most of your listeners are aware of, given what took place. But basically, that's a bundling of loans into a package, and that package now becomes a security like a bond. It ballooned. I mean, astronomically. Yeah. And it became a huge revenue center for a lot of the very large banks. You fast forward a little bit, and people got extraordinarily greedy, very, 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 very complacent. And a lot of the standards of care that went with having loans on your balance sheet disappeared because they just figured they could sell it into the market, and the market was always liquid, so they never had a problem. Well, all of that really turned out not to be correct. And what ended up happening was the financial crisis, which we could spend a long time talking about, but I don't really think that that's where we want to go. The financial crisis happened. A lot of very bad things happened. Not enough people who did some very bad things got actually punished. But what did come out of it was Dodd-Frank. And Dodd-Frank is a very, very large piece of legislation. And that legislation really, at the end of the day, tried to roll back some of the activities which really were unwound over the late 80s and through the 90s, and even into the 2000s. Now, they were never going to really try, though there were some voices raised about it at the time, go back to the legislation post the 30s, which was to actually split investment banks from commercial banks. I think the general feeling was that globally, that would actually long-term put the United States at a disadvantage because the Europeans never really did that. So a lot of European banks are basically both. I mean, Deutsche Bank is both a traditional commercial lender as well as a global investment bank, if we can just use that as an example. And so between lobbying and the realization that trying to separate the yolk from an egg would be rather difficult, they didn't go that route. What they did go is a route where you had a lot of minimum capital standards. Those capital standards were going to be tested every year by the Federal Reserve. And those were going to allow banks to return capital to shareholders or not in the form of dividends and share repurchase programs. But they also entailed a lot of other things, like what kind of trading activity banks would be allowed to engage in, what kind of products they might be allowed to engage in, the level of capital and risk that is associated with those activities. It's a fairly long, very cumbersome list. Now, a lot of the smaller banks, and of course, small today is different than small a decade ago or 20 years ago because the economy has grown. But a lot of the smaller banks, let's say banks below the top 20 or 25, you have to remember that when you put in regulation, that's cost, right? Like there's a cost to regulation. There's never been a piece of legislation that's ever been put out from an enterprise perspective, from a company perspective, that didn't entail cost. Now, if you're J.P. Morgan and you've got $2 trillion of assets on your balance sheet, and you've got literally millions and millions and millions of customers around the globe doing all manner of activity, your ability, even though managing it is obviously much more intensive than, let's say, a local bank, your ability to distribute that cost over, if you want to think about it, a number of units, right, is much better. It's a lot easier. And so while the pain is real, while that costs are very real dollars, your ability to absorb it is better. Now, if you're a smaller bank, you can't really say that. You don't have the same size of assets, and you don't have the same number of customers, and you may, in fact, actually might not even have the same amount of banking activity which generates revenues over that expense. And so some of it is a legitimate encumbrance to them. It's a burden, and given their general business activities and, frankly, their ability to negatively impact the economy overall is much smaller than, let's say, the top 20 banks, because the top 20 banks in this country are someplace around 80% of the country's deposits and loans. So you could see that, the number 50th bank, if they do something silly, their ability to actually do something bad in the economy is obviously much, much smaller. Mm-hmm. And so for a long time, those banks have been lobbying regulators and legislators to change the rules. And legislators are not inclined to necessarily turn around, nor are regulators inclined to turn around and undo rules very quickly after crises that put them in to begin with. Because, let's just be honest about it, if there's a problem, the egg is going to fall on their face. And so it has been about a decade since the crisis happened. The banks are much, much stronger than they were. But now, don't get me wrong. I'm not telling you there's no foolishness that's going on. There's plenty of foolishness going on. There's always been foolishness going on, and as long as we're on this planet, there will be foolishness that goes along in the financial markets. But everything else being equal, the industry is managed much better. The capital levels are much better. The reserve levels are much better. And the oversight on all of that is much stronger. And so
could you argue, Barry, that regulation did its role, performed its role by keeping getting the banking system stronger?
I would argue that 100%. I would. I think that while the profitability, and there's a lot of reasons why the profitability of large institutions have come down. I mean, interest rates, competition,
right?
The maturity, the growth, how fast the global economy is going. I mean, a QE, a quantitative easing, which is the global impact of all of the central banks around the world. All of that has had, in one way or another, and of course, pricing has been under pressure for a lot of reasons for the last 20 years. All of that has had some level of impact in one way or another on financial returns. But without a doubt, the industry is very healthy, makes a reasonable rate of return on its capital, and all of that is due to the fact that these regulations were put in place. So had you left it to the bankers, they would have partied on as long as they could have, and would continue to be partying and never have taken the steps that these regulatory rules required. There's no incentive for them to do that.
It's interesting. You mentioned First Union, and I remember a period, and not being a banks analyst, a financial services analyst, but I remember a period, late 90s, early 2000s, where it seemed to me, just to be an observer of the markets and investing in the markets in other industries, that banks were like these growth vehicles, these, like you said earlier, these M&A machines. And I remember, like you, I lived in New York City, and it seemed on every corner there was a new branch popping up, and it was a branding exercise. And all of a sudden they felt like consumer brands, and instead of staid banks and conservative banks, and they went into this just hyper growth mode. And of course, carelessness takes place when that happens. And we know in most industries, when you do a lot of M&A, most of them don't work. Probably 9 out of 10 deals fail. And so I could see how regulation did make sense. And so here we are, like you said, the banks have all this great, the balance sheets are great, their ratios are great, everything is better. And now we get this reform at a period where you can make an argument on the overall market, right? We still don't know how the global central bank experiment plays out when rates are rising. We're going to touch upon how contagion and crisis can happen in a bit. But what's your thought on the impact of this rollback?
Well, I think it's too early to tell, but I think there are several things that are likely to happen, and they're not going to all happen at once. And of course, whenever anybody says this, they also assume, whether they realize it or not, that you're not talking about, okay, next year we're going to be in a recession, right? So barring a negative downturn in the economy, which typically, banks typically contract at that point, right? Because they start tightening their standards of lending, and they're really worried about the integrity of their balance sheet. And you don't really see much in the way of deals during that period of time. So barring a recession and the impacts of recession, I'll give you a view of what I think is going to happen. One is, you're more likely than not going to start to see regional banks be able to be a little bit more aggressive in terms of going after business. The great thing about being a local or regional bank is you really know your customers, and your customers really know you, and you're there for the long haul, because unlike Bank of America or JP Morgan, if they don't like what's happening in Florida or California, they just go someplace else. If you do most of your banking in 3 states, right? If you're a bank and like 90% of your activities in 3 states, you're not going anywhere, right? Like, you're there. That's your home turf. So I think you're going to start to see more activity there. Number 2, as these rollbacks of regulations take place, there should be some benefit to these banks in terms of their expenses. And of course, when your expenses go down, some, if not all of that, depending upon what a bank wants to do with those savings, are going to go to shareholders. And the third is, it really might give an opportunity for certain banks that might not have engaged in mergers and acquisitions because they didn't want to necessarily breach the dollars of assets on the balance sheet, which then would put in a lot of cost structure into the bank for regulatory requirements. You might start to see, and again, I'm not saying you're going to see this day one. You might start to see more consolidation in the banking area, especially at the lower level, because they're not really worried about violating that asset level. And that in turn will lead to more rationalization of branches and expenses. And so you can start to see that kind of activity. And so people who invest in, kind of the mid-cap to small-cap bank area, could start to see their own little mini M&A cycle that takes place. Now, of course, this has nothing to do with what large banks will do, because if they buy a small bank, that has 10 billion assets, but they're already over the minimum asset hurdle for Dodd-Frank, that doesn't mean anything to them. They're doing the deal for different reasons. But I do think in the smaller cap, mid-cap area of banking, you could start to see some M&A.
So I want to bring in investors back to the period of the global financial crisis. And I want to do that because, I've been talking to listeners about risk on, risk off, and what it means for their portfolios. And we've had a very, very nice, 10-year run in the markets. And it's been more risk off, meaning there's not a lot of fear in the market. And I'd love to talk about sitting in your seat when you and I were partners at one of 5 or 6 partners at a big hedge fund at the time, and leading into the global financial crisis, what you were seeing. And I think that we had come off a really big move in the market. And what are some of the things that you, as a bank analyst, look at and look for to say, I could see that it's risk off right now, but here are some of the things that I'm putting on my radar, kind of like a watch list of things that you're thinking about. And then we're going to talk about if translating that into what people should be thinking about today. But pre-housing short, the subprime collapse. I mean, how does a bank analyst think about the world, and why is that important to the overall markets?
So I don't know if I could speak for all the bank analysts, but I'll speak for myself. One of the things that I spend some emotional energy on, and I do mean that, is never letting my skepticism override, my optimism. And I think that if you've covered financial services as long as I have, that's actually a bigger test than you might imagine, because while this might not sound like a nice thing to say, I think I could stand up in front of anybody and defend it. I've never been in a meeting with an executive team for a financial services company where I didn't know in one way or another they were lying to me. And sometimes I know or have an inkling about what they're lying about. Other times I just know they're lying to me. And when we were, Mike, when you and I were partners at not, a multi-billion-dollar hedge fund, so we would sit together and you would ask some questions like this too, and I would look at you and I'd say, well, what do you think about a company that you could take the same asset, a mortgage or a bond, and you could, in theory, account for the very same asset 5 different ways, and all of those ways would be defendable or acceptable. What do you think your ability is to manipulate what the world looks like? And sometimes for a very, very long time. And, when you're a bank analyst, you got to remember that 90% plus of your balance sheet is sitting against the opposite in terms of equity. So if you've got 95% assets, you only have 5% equity.
Right.
So you literally have to, a 1% move in your asset base can pretty much wipe out your capital. And so every day you're thinking about the world and you're thinking about what's going wrong or what people are doing or how they might be manipulating things or, are they attempting to hide something? Are they over-exaggerating something? A lot of your day is spent trying to figure out or think about what can go wrong. Because thinking about what can go right is really easy, right? That's not hard. The hard part is thinking about what can go wrong. And, what you realize is that you really almost have to chase down anything that sounds reasonably large enough to be a problem. Whether it's, changes in interest rates and how that might impact the mortgage market or mortgage companies' servicing portfolio, lending standards, is somebody growing a portfolio much more rapidly than, let's say, the overall market is? These are all signs. Is somebody booking revenues at a rate that is in excess of, let's say, the average in the industry? These are all signs that, and there's many, many others, that there's something going on that needs to be investigated. And sometimes you could figure it out. And, sometimes there's reasonable answers for it and sometimes there's not. I mean, I'll give you an example. Way back in the day, there were a number of Puerto Rican banks. And Puerto Rico is, as all your listeners will know, is an island. It's not an island whose population grows all that much, and the land mass is pretty much fixed. And there was a Puerto Rican bank that was booking huge amounts of mortgage growth and were booking the revenues from producing those mortgages at rates that were 3 to 4 times higher than what, let's say, a comparable bank in the United States would be doing for what they said the credit quality was. Now, I don't know about you, but I didn't think there was anything magical about mortgages being originated in Puerto Rico, where a bank could literally book revenues that kind of size relative to, let's say, a mortgage in the United States. And so I spent a fair amount of time kind of delving through it. And the process was fairly intense because not all this information is public. So you have to talk to guys who buy the product and ask them kinds of questions like, what are your expectations? Or what have you been told is going to happen to the mortgages? What have you been told about the credit quality of the mortgages? What is your experience with that? How does this product work? And why can a bank do that? Now, when you go through all that and you read document after document after document, and you sit in front of your Excel spreadsheet trying to model it out, and all of a sudden you realize that you can't do that. There's no economic justification for it. You get in front of the company. Because now you have in your hand the information you need to confront them. Now, when I say confront, I don't mean, in an obnoxious or kind of cross-examinatorial way, more just Q&A. But you have stuff in your hand that they need to explain. And when they can't explain it, or when their explanations are, jumping through hoops and all kinds of contrivances, and you could see how uncomfortable they are, that you're onto something. And that's when you act. And that's when you get involved from a stock perspective. Now, in this particular case, we were very, very short them. And this is just a very small example of what happened. And this was before, by the way, the financial crisis. There's a lot of shenanigans that went on all around the world before the financial crisis. And when the financial crisis hit, or before the financial crisis hit, I should say, we were really nervous. Like, I can remember when I joined the firm, I spent the first 6 months actually talking our portfolio manager out of owning companies that he had owned for 5, 10, 15 years. And his view was that they're fine. They're wonderfully managed companies. My view was is that they might be really well-managed companies, but what's about to happen is going to hurt everybody. And so I know that might sound like hard for your listeners to understand, but I really spent the first 6 months talking our portfolio manager out of owning what he owned, and then the next 6 months getting him to short things for us to make money. So,
Well, it's interesting, Barry. So what you're saying, so for instance, we use that one bank in Puerto Rico as an example, but it's interesting because investors allowed that to occur, right? So do you look at that to speak to the mindset of what the market is willing to bear at the time? Because I'm sure, and if memory serves, that wasn't the only bank where you were starting to see things that just didn't kind of make sense. And I remember walking into your office where time and again you have these ridiculously large spreadsheets that you're working on, and your office just 2 feet high with documents all over the place and a lot of Post-it notes throughout them, where you say, well, wait a second, this doesn't make sense. Is it kind of in the ether typically when you start to see stuff like that, where, you know what, the bank analysts, they get a little complacent and opportunities for this type of stuff occur? Or do you find it's more one-off type stuff?
Well, I mean, an event like the financial crisis, thank goodness, is a little bit more one-off than not.
Yeah, but leading up to it, meaning as it's going into it, you're starting to see it throughout different.
Yeah,
different.
Well, like the entire. So most of the market is relatively complacent, and I don't mean that just in banks. I mean most of the market. So allow me, if you will, to give me 2 minutes and explain why I think a lot of the market is complacent.
Yep.
Think about how large indexing is in the stock market and the bond market. It is essentially the way the vast majority of people invest. Are you really making decisions if you're indexing? Not really. No, you're not. Like, around the edges, you might say, okay, well, we need to rebalance the portfolio a little bit, but that has nothing to do with making a real judgment call about what's happening at a company or an industry or even the market overall. And the bond market is even worse than that. Bond markets are mostly buy and hold. Insurance companies they own tons of bonds. They own bonds for a very, 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 very long time. The municipal bond market is, buy and hold. And one of the reasons is that even though the bond market is enormous, I mean, trillions and trillions of dollars, it's not actually really liquid. It's very, very, very hard to buy and sell $50 million of a given bond. It's shockingly hard. And it does have a propensity to lend itself to complacency. Now, I'm not saying that these aren't brilliant people that are managing money and are thinking about things. They are. They're incredibly talented. It's kind of more or less the nature of the beast that lends itself to that. And then also, like, you have to remember that people tend to feel comfortable holding on to the things that they believe, and believing them for a very long time. Like, how long was it when we were first starting off in the business, Mike, that everybody would say, buy the dips, buy the dips, buy the dips,
Yep.
dollar cost average. I mean, literally, this was a mantra. This was if you were in the markets in the 90s, that's all you heard. You put the TV on, that's what you heard. You read something in Investors Business Daily, that's what you heard. You were sitting at a meeting with a portfolio manager, that's what you heard. You were out with dinner with your friends, that's what you heard. And everybody believed it. Everybody everybody believed it. They took it as gospel. Okay? Not everybody, but most. And so complacency is part of the human spirit. Now, the job as a professional, frankly, is to constantly remind yourself that what you assume is correct may in fact not be. And there's a huge difference between conviction in your ideas and hubris. And oftentimes people get confused between those two. And the best analysts that I've ever seen, the best portfolio managers I've ever seen, are the ones that have the smallest egos, because they realize that at any moment they can be wrong. And so, our little example of the Puerto Rican banks were just that. It was a little example of it. And the market just was complacent. It took for granted that when a rating agency said that a securitization was AAA rated, that these were high quality assets. Yeah. And they had to do, and there was so much money coming into the market, and people were chasing yield and return and the pressures of putting that money to work. And they looked at those rating agencies and they would say, oh, these are mortgages and they're backed by, Goldman Sachs did the deal or Morgan Stanley did the deal or this, that, and the other thing. And they go, of course they have to be quality. Of course they have to be, there's no guarantee that it works, no guarantee that there's not this, that, and the other thing. But in the aggregate overall, that's exactly what people were saying to themselves. Now, had you actually sat down and read 5, 10, 15, 20 of these things like I did, you would realize very, very quickly that there's a little bit of a problem here. Now, that happens in every market cycle, and it's happening right now. Yep. People are just complacent. They just assume that the Federal Reserve or the central banks in Europe or China or all these guys are just going to magically make it work, right?
Barry, I laugh. I mean, it's comedic when everyone hinges on the words of the Fed, and they're dovish, they're hawkish, they're worried that rates are going to. When do these guys get it right? Right? I mean,
never.
Putting your faith in them is stunning. When's the last time the markets were allowed to really experience true price discovery without government interference? In the early 20s, before the Great Depression, when the Fed stepped away and said, all right, let's see what happens. But now it's everything's propped up. And I find it comedic. And they take their cues from these bureaucrats as though they have the answers. And it's stunning to me. And you see the complacency that settles in. And that's a great point you bring up about complacency. I want to shift gears for a second. I didn't mean to interrupt you, but just in the interest of time. I think back to I remember vividly during our time at the fund where the European debt crisis was a big deal. And I think back to 2012 when Mario Draghi, the head of the European Central Bank, I mean, his goal was to quell any concern that market turmoil was going to force countries like Greece and Portugal and Spain and Italy out of the Eurozone, right? Because their debt to GDP was enormous. There was concerns that they couldn't pay their debt, and you had the restructurings going on. When did that become fear in the market? Was it a big lead up to it, or did it just people wake up one day because they were complacent and say, oops, look what we're dealing with now?
Well, I'll tell you, it's really crazy to understand what's going on, because all of I like to say the footprints in the sand, if you will, for all of this has been around for a really long time. First of all, when the euro started, there were there's lots of articles written, lots of journals, lots of academic studies talking about how inconceivable it is to have a single monetary system with a different set of group of countries that have different political, cultural, and budgetary influences. The United States, if you want to think about the 50 states in the United States as all the countries that are in the Eurozone, the U.S. dollar isn't related to what the state of Illinois is doing with their budget, but the euro does actually have some impact on like what's happening in Italy or Spain or France or Portugal or Germany, right? And so while it seems like it's the same as the U.S. dollar, it is in fact actually quite different. And there's no real way about it. I mean, they are. It's almost like a condominium, right? They're forced to try and get along with each other, but they don't always really like each other.
Yeah.
Right?
Right.
They're like an angry condo.
You know, it's funny because I think back to them in 2012 when investors concerned were that a country would be forced out of the Eurozone. Yet,
Greece.
Greece, right? Now, today, it's very interesting because while the impact to the euro and to the debt markets can be staggering if something were to happen to create that, back then it was being forced out. Today, the concern is a different one. It's a country choosing to leave. And we see what's going on in Italy, where with there's this rise of populism, where the country risk is different, right? The people are saying we don't want to be part of the euro, right? So how does that impact? Like today, I see, Italian debt went from a negative interest rate to over 1.25% recently. It's gone parabolic. It's gone through the roof, right? So the euro is down to its lowest level against the dollar. It's trading at 115, and you're seeing just this morning the safe haven people flocking to the dollar and U.S. Treasuries because it's been risk off, right? And now all of a sudden, because the Italian president didn't bless the populist party's candidate, you've got all this noise occurring. How do you think this plays out? And you mentioned earlier, I want to see how it ties in because you said earlier, just a few minutes ago, you feel that same type of complacency in the market right now. And now this is something that you wake up this morning, all of a sudden the euro's imploding and government bonds are going up because people are flocking to buy them. What in the U.S. while the Treasury, while the German Bund and the Italian, Italy's bonds are going down. How do you think about this as from a bank analyst perspective and the impact on the markets?
So everybody, again, when you have a central bank, whether it be the European Central Bank or the Federal Reserve here in the United States, who are enormous and have, for all intents and purposes, unrestrained and unlimited abilities to be active in the marketplace. It has a tendency to do a couple of things. One is it has a tendency to create complacency because every large institutional investor on the planet, every trader is going to say the exact same thing at the exact same moment, which is, oh, well, now I know there's always a buyer, what's known as a buyer of last resort. That is to say, under the worst case scenario, I don't really actually have to worry about the worst case scenario because there's somebody there that's going to bail me out. And in this particular case, it's the central bank in Europe. The other thing that it has a tendency to do is because they are so active in the market, it doesn't let normal market forces determine prices for individual assets. And so that's a fancy way of saying that if the European Central Bank wasn't active as they are, perhaps Italian government debt would never have ever had yields that it had a year ago or 2 years ago or 3 years ago. Because
I'm going to ask you to stop there. Just for listeners who, what you just said to a professional investor or an experienced investor, they might understand. But for someone who's trying to learn and get up to speed, when you say central banks are active and it allowed this to happen, explain what you're talking about by that. Just break it down in layman's terms.
Sure. So a central bank, I'm assuming most people know what a central bank is, but just for explanation, central bank
like the Federal Reserve, we'll say.
Is like the Federal Reserve in the United States. And when I use the word active, they are quite literally every day in the markets buying bonds of all types in Europe. And by doing that, they create a floor for what things are worth, because everybody knows a very, very large buyer, the central bank, is active or in the markets every day buying Italian debt, Spanish debt, German debt, Portuguese debt, Greek debt, you name it. And it's not just government debt that they're buying, okay? They also buy debt issued by European companies.
And also, Barry, just for those who may not know, interest rates, the yields work inversely to the price. So when you're buying debt and the price of that debt is going up, if the bond price, just like a stock, if there's more demand for something, the price will rise. So if the price of the bond is going up, the interest rate is going down. And that's what these banks are trying to do, is suppress interest rates to stimulate economic growth. So I'm sorry, go ahead.
That's exactly right. I mean, if your listeners want to have a visualization, kind of stick your arms out like a seesaw, and on the left side is the price of the bond, and on the right side is the yield on that bond. If the price goes up and you're moving your left hand up because the price goes up, you'll notice that your right hand goes down, so that your yield would go down. Now, if you do the opposite, which is the price of the bond goes down, you'll notice your right hand goes up, which means the yield goes up. And when I first started out, I needed a visualization to remember that, so I just always remembered.
So Barry, it's interesting because it serves two purposes. One is it creates confidence because the buyers of bonds say, "Oh God, there's always someone much bigger behind me willing to buy." So that gives them this sense of security, and then secondly, it suppresses interest rates.
It does. It has it. So interest rates in bond land are really basically the way that people think about risk, right? So if you thought something was really risky and you were going to own a bond, I mean, logic would suggest that you would want a higher interest rate to compensate you as the investor for owning that bond, which has more risk than, let's say, another bond. Now, when you have, again, we'll go back to the central bank, when you have a buyer buying literally trillions of euros or dollars of this stuff, that yield, that interest rate that the market would normally require in order to entice it, if you will, to incentivize it to own these bonds, kind of goes away. And people are just buying things because they're buying things. Now, every once in a while, you have a shock to the system. Now, at the beginning, we had, Portugal and Greece, and there was a lot of turmoil there, and there was a lot of shock to the system. And I'll give your listeners an idea of what I mean. That in December of 2009, I actually looked back up these numbers. The spread, and so I'll tell you what a spread means. So maybe they don't know. A spread is the difference between one interest rate versus another interest rate. So an easy way to think about it is if the 10-year in the United States is at 3% and you want to get a mortgage, and let's say the mortgage costs you 4.5%, you would say the spread is 1.5%. Okay? It's a very simple way to think about it. Yep. If you look back in December of 2009 and you look at the spread of Greek bonds versus, let's say, German bonds, I believe the spread was about 2.3%. Okay, so Greek bonds were paying 2.3% more than German bonds, which are considered to be very high quality bonds because of the German economy. By the end of 2010, so essentially 12 months, that same Greek bond was now literally almost 10% higher than the equivalent German bond. So you
10 percentage points higher.
10 percentage points. So you went from earning, let's say a German bond at the time, just for purposes of simple math, had a yield on it of 1%. In December of 2009, the equivalent Greek bond would have had an interest rate of 3.3%. Within a year, that Greek bond now had an interest rate of 11%. Now, that's the kind of thing that can happen when you don't have a central bank influencing price, and the market is worried about something like leaving the Eurozone. And so when you brought up earlier that Italian bonds basically went from having what's known as a negative yield, where you effectively are not actually earning a real return on the money you give somebody for owning their bonds, to now having a positive yield, way over 1%, which by the listeners might be like, well, that doesn't sound like a big deal. It's enormous. It is an enormous big deal. Bond markets don't move like that. They typically don't move that quickly and viciously. And that's why I talked about the Greek thing, because you could literally see how bad it can be if you don't have a federal bank intervening. And right now, the Central Bank of Europe is still in the market. It will intervene. But if Italy, for one reason or another, was to actually leave the Eurozone, the spread, the cost to Italy for money in the open market would absolutely balloon astronomically, beyond all possible understanding. And that is an enormous, and I do mean enormous, risk.
And so so what we're kind of, I have a common theme that I've been saying since I started the podcast, which is, about the risk on, risk off, and stay cautious. And I point to a lot of things U.S. centric, but one of the big things is this global central bank experiment. And, there are these things that just kind of come up, right? And when valuations are high, I'm not saying that they're egregious, but when valuations are high, and you have this long period that we've had, kind of like a Goldilocks stock market, things tend to play. And one of the words I saw bandied about this morning that you heard and hadn't heard in a long time is contagion, right? It's spreading, and and these things just kind of take a life of their own. So I mean, when you think about, and the overall what's going on and what we're seeing starting to happen is, how do you start to think about what the impacts could be? Is this a time where you're more this adds caution to it, or do you think this is just a one-off type thing and they'll fix it right away and don't worry about it?
Well, you have to worry about it. So let's put this in some perspective, okay? And it's always good to put some numbers around these things. Because I'm a bank analyst, one of the easy ways for me to kind of think about risk is thinking about a banking system. And the Italian banking system has about 4 trillion euro. And so a little back of the envelope math would be that's about $4.5 billion US dollars. I'm sorry, 4.5 trillion US dollars of assets in it. Now, if Italy was to leave the euro, that typically wouldn't happen instantaneously overnight. I mean, the events that cause it might happen instantaneously overnight, but how that actually happens probably wouldn't happen overnight. You basically have $4.5 trillion of assets that no longer have $4.5 trillion worth of asset value in the banking system, which means that given that there's about 350 to 400 billion US dollars of problem loans, and problem loans are loans that are not paying interest or haven't paid interest or not paying the amount of interest that they should, or whose assets no longer are valued the way they could be. And that's 10 years after the crisis. Basically, the entire banking system of Italy would no longer exist in multiples and multiples and multiples. Like, you couldn't raise enough money to have a banking system that was solvent at that point, because what would happen is that instead of being able to issue loans or currency in euro, when you leave the euro, you now have to issue your own currency. And most likely, if it was the Italians, they would go back to the lira, which was the currency they issued before the European Union created the euro, because the risk in Italy would be greater than the rest of Europe because they left, not only would their cost of money go up, but the value of, let's say, this imaginary lira, which they would have to issue, relative to the euro would be considerably lower. Now, how much lower, I don't know, but it wouldn't be shocking to think that it wouldn't be someplace in the neighborhood of 25 to 50%. And the reason is that the Italian economy is very, very, very anemic. It really hasn't grown much over the last 10 or 15 years.
It's also, I think, that it's the third biggest one, too. I mean, it's a big economy. In Europe, third biggest in Europe.
It's the third largest economy by gross domestic product in Europe. And Germany and France are 1 and 2, and then Italy. But Italy has a lot more debt on its books than France or Germany. So like Germany, if you look at debt relative to GDP, which is a fairly often cited ratio, Germany is around 64%, France is around 95%, but Italy is about 130 to 135. And so, normally most economists say that when you start to get to 100, like that's unhealthy, and they are way, way over that. And so their banking system would be functionally bankrupt. You would see enormous inflationary pressures. The country would have to kind of, basically for all intents and purposes, devalue an enormity of debt that is staggering to imagine. It would ruin the economy for, quite honestly, probably several generations, and throw Europe into an economic turmoil that would at least rival the financial crisis that we experienced in 07 through 09.
And so if you're a U.S. investor and you're sitting, or a Canadian investor, an Aussie investor, and you're sitting here and you're saying, well, what does that have to do with me?
Well, it has everything to do with you, because nothing is, there's the days of that's over there, it doesn't matter to me, are long gone, because everything is intertwined.
Yep.
Our economies are intertwined, our cultures are intertwined, our banking systems are intertwined, and information moves faster and broader than it ever did before. And people will react, whether it's in Canada or Singapore or Milwaukee, to this kind of event in a decidedly negative way. And so while Italy's long-term economic problems are Italy, the impact on the world would be enormous. There's just no getting around it.
No, it's going to be interesting to see how this plays out. Let's shift gears.
Yeah, it sure is. I mean, at the end of the day, I think given what's happening in the markets, people are shocked and surprised and nervous, but asset prices haven't moved in a way where you would think that people think that the worst is going to happen. Because I'll tell you, if people thought the worst was going to happen, what people are panicked about now would be child's play.
Yeah. Stay cautious, my friends.
Stay cautious.
So let's shift gears. So after, God, I don't know, 20 plus years, you and I have known each other 20 plus years, and you were in hedge fund business for a lot of those almost 25 years, I think, if I'm not mistaken. And the last year or so, you've moved from New York down to Florida, and you've just taken a break from the hedge fund industry, just kind of semi-retired. And I know you. It was funny when you said, I'm moving down to Florida. I want to be by the beach, and we're going to enjoy a nice quiet life. I kind of laughed. I said, yeah, okay, good luck with that. That will last about 5 minutes, but I didn't have the heart to tell you. So you're down there, and you manage some people's money, but when I told you what I was doing with Frank at Curzio, I said, this newsletter thing is really interesting. It's a way to share a lot of what we've learned with regular investors who might not have the experience. And And you had for, I guess, the last couple of years started to really take an interest in the digital currency, the cryptocurrency market. When you told me that you were starting to look at that, I thought it was kind of a natural because as, when you say bank analyst, people think, oh, you're looking at just financial statements. But one of the things that always I realized I learned from you working with you was how much financial technology is involved with payment systems and all of those, the technological aspect of banking, that when you and I started talking about the crypto land, and I still know nothing about it, but you and I started talking about it, and I realized, my God, this is for you. This is right exactly what you did. It's digital currencies, it's financial payments, it's all this other stuff. And so you had started doing it, and I had introduced you to Frank, and lo and behold, now you're doing a newsletter for Frank. So talk about the transition from A, New York to Florida, but B, I want to know how the pizza is down there, but also if you could talk about the similarities between banking and cryptos and kind of where you see everything's going with it.
Well, I'm not going to talk about my transition to Florida. I'll let, because some people may agree or disagree with it, but I will say that I'll put a pump in for the only pizza place in Miami that I think is worth going to, which is Lucali's, which is actually the same guys from New York, and it's a godsend, to be honest with you. But we'll talk about Florida another day. The transition from traditional asset management, traditional assets, specifically around financial services, into the crypto space does have some very natural pathways, right? Like, and you brought up really basically what they are, which is what is money, payments, and all the things that are around that, including the technology. And then also the technology itself. And I was lucky. You covered technology for a number of years. And earlier on in my career, I was actually lucky enough to have covered software companies for a couple of years for a firm called Fred Alger in New York City as an analyst there. And they're a mutual fund company. They still exist. And so I have a little bit of tech under my belt and 20 years of financial services under my belt. And crypto is the natural gateway. And you introduced me to Frank, and we're going to be launching very soon a newsletter. The title of the newsletter is going to be Crypto Intelligence. We hope to deliver a lot of really good stuff to people who are both new to the space as well as people who have been around it for a little while, educational, informational, as well as ideas for investing in the space. And you're right. You were right when you said that we've been talking about this for a long time. It goes back a long, long way. It actually goes back before you and I were partners at the same firm. When I was managing with another longtime friend of mine who you actually know, Dan Orlow, when we were managing about $350 million of Merrill Lynch's own money on their prop desk, Dan and I would talk about this all the time. And in fact, actually, Dan worked for the Fed when he came out of school, and Dan actually wrote a paper for the Fed that dealt with, and this goes back into the 90s, the idea of digital currency. So we've been kicking this can around for actually a really, really long time. And now I've decided to take a great leap and spend all of my professional time focused on this space. So,
I mean, I think digital currencies, I think Bitcoin, and it's up, it's down, it's all over the place. But in talking to you and you trying to educate me on it, and I know better that I'm not going to try and dive into it because I'll just ask you. Why do that when I've got somebody that's as smart as you to do it? But to the average person who hears about Bitcoin, hears the headlines, it goes up, it goes down. What's evolving in digital currencies? What's the world like? What is it? Is it just Bitcoin, or is there more to it? Is it people hear about blockchain? I mean, what what's driving all this stuff?
Right. So I think the first thing for listeners that are not quite as familiar with this area as some others might be is that you have to separate blockchain from cryptocurrencies. So like Bitcoin, when people think about Bitcoin, they think about the cryptocurrency, and they look at they may be seeing CNBC or reading the Wall Street Journal, and they'll read an article and they see the price is this, the price is that. That's the currency, okay? But then there's the technology that lies behind the currency, which is often just cited as the blockchain. Now, each one of these, many of these, are their own blockchain. So there's actually more than one blockchain. Like Bitcoin has their blockchain, Ethereum has their blockchain, Stella has their blockchain, Zcash has their blockchain. And not all of cryptocurrencies have their own blockchain, but a lot of them do. Some cryptocurrencies are actually individual businesses that borrow or use another company's blockchain. So, for example, there's a company called Funfair, and Funfair is a cryptocurrency, and Funfair is in the online gaming business, and I don't mean like the games that our kids play online, like Fortnite. I mean like roulette and blackjack and slots and things like that. Their cryptocurrency actually uses Ethereum's blockchain as their backbone, and so it's a very interesting space because you have full-fledged blockchain companies like Bitcoin or Ethereum, and then you have these other projects and companies that actually reside on these blockchains, but they try to solve a myriad of other problems. And some of them are significant, let's say like medical records, those are real life, very significant projects. And other ones are fun. They're trying to solve a problem, but they're trying to bring something to consumers. In this particular case, I used Funfair as an example, where they're trying to solve the problem of trust and cost for people within the online casino space. But at the end of the day, they're a consumer product. They're a fun end use consumer product. They're not trying to change the world. And you literally will run the gamut between one versus another. And so those are like those are the major things that I would say that people have to keep in mind with respect to blockchain.
So when I think about cryptos and the coins, and here's what I'm trying to get my head around: are they speculative currencies based on a store of value? Whether we're talking, the bigger ones, Bitcoin, Ethereum, Stella, whatever it may be. Are they speculative trading assets, or are they stores of value, or is there a utility to them? How do you think? Because one of the things, and I think as I look at the space, that I don't know, 1,600 of these things that have come out. How do you know what's real and what's not real? And how do you know what Bitcoin has a first mover advantage? What does that mean? How do you parse the world out?
Yeah. Well, you've hit upon basically all the high notes. So I'll start by talking about risk. In my personal opinion, 90% of these projects are going to fail. So if you believe that, which I do, I think it would also be fair to say that these are very risky assets. Because what I'm literally saying to you is 9 out of 10 of them who raise money will fail. And I believe that. I don't know if it ends up being 90 or 80 or 95, but 90 is a pretty good number to use.
And why do you say that?
Well, there's a lot of reasons. First of all, some of these businesses don't really need to use blockchain for what they're doing. That's number one. Number two, many of them are very, very poorly managed. They don't have anybody that has prior business experience. Their business models are not extraordinarily well thought through. The end markets which they're attempting to go after are extraordinarily competitive. and a lot of the people that are entering them have no prior experience in those markets. Some of them aren't well funded. Frankly, a lot of them are just scams, right? Like the people that, the business is a scam, the technology is a scam, and the business model is a scam. And
so how do they ever raise money?
Well, they raised money because there's a lot of people who can put on a really great marketing show. There's a lot of people who will say things that aren't true, but people believe them. There's a lot of people out there that get paid to say things for these companies that don't disclose it, that people listen to and people follow. And yeah, that's what happens. There's no intermediate. Let me rephrase that. When you do an IPO, there's a lot of steps that go into it. Some are regulatory and legal, like filing with the SEC or some other governing body. But before that, you actually have an investment bank that stands between you and doing all of that. And investment banks, even though people say they're greedy and all they care about is making money, what they also care about is their reputation. And the last thing that you really want to be known for is doing deals with companies that are bogus, because at some point you can't do any more deals. And so there's a natural gating mechanism in investment banks where it serves their purposes to only underwrite companies which are legitimate, or as best as one could do due diligence on and say they're legitimate. None of that exists here. There are no intermediaries that act as gatekeepers. There's very little in the way of somebody on the outside saying, we're going to give you the good housekeeping stamp of approval because we're valid, because we've done this before. And therefore, really anybody who wants to say they're a blockchain company, in principle, pretty much can. And you've seen some of this even in the public markets. Remember, what was it? The Long Island Iced Tea Company decided they were going to now be the Long Island Crypto Company or something like that. I mean, You've seen all kinds of stuff, right? All kinds of stuff, because there's little in the way of regulation, and there's little in the way of a gatekeeper, a shepherd, if you will. So that's why. And one of the things that we're trying to do is act as your crypto shepherd, if you will. We're going to try and keep the flock away from the wolves.
That makes good sense. It's fascinating, and it's really an interesting. It's like the wild west frontier days of venture capital. So it is, and most people have no access to venture capital. The traditional form, right? You need to be an accredited investor to put money into a venture capital firm, and here anyone could go buy digital currency. So I could see how. It brings out some bad players. So it's good that you're going to be really just sniffing it out. I mean, can you give listeners just a couple of things that are high on your list of what you look for?
Sure. I don't know. We've talked about this stuff a lot, not necessarily crypto, but just kind of in general. I mean, the team that you're investing in, I think, is critical. And no more so critical than in crypto, because at the end of the day, Mike, and this is for your listeners too, really what you're investing in is early stage software development. And there's very few things as risky as early stage software development. Maybe biotech is up there, right? That's early stage biotech that hasn't even gone to trial number 1 yet. That's what this is like. And there's little in the way of disclosure. There's little in the way of follow-up. And so the team for me is almost the number one thing I look at. Your project, I want to know about, and that's also on the list. But the team, bet on the team. I would much rather have an A team with a B- project than an A project and a B- team. And it's the number one thing. The second thing I look at is, what is the project? Does it make sense? Do you need the blockchain? Is it a new frontier market? You think you got an idea that is new or brand new and could be enormous? Or are you going after a pre-existing market, but you think you could do it in a way which is unique, and therefore you can take those economics that are in that pre-existing market and you can move those economics to you? So that's number two. Number three is, what's your business model? How do you plan on earning money? Because at the end of the day, at some point, the value of the cryptocurrency, in many cases, and we could talk about Bitcoin or Ethereum later or another time and why those are different than what I'm about to say. But at some level, most of the coins that are out there are just businesses that happen to be blockchain businesses. And those coins, no matter how you look at it, are going to have value because those businesses are economically self-sustaining, which is a fancy way of saying our expenses are less than our revenues.
Yeah.
And, as long as you have a pathway, and believe me, best efforts, people can make mistakes. It might not go their way. Competition. There's all kinds of things that can get in the way between that. But as long as you have a roadmap that suggests that there's a legitimate way that your revenues will be greater than your expenses a year from now, 2 years from now, 3 years from now, because startups don't necessarily always turn profitable right away. Few do, but most don't. You could be viable, right? And so that's number three. Number four is kind of the token themselves. What is the model when you issue these tokens? How are you issuing them? Is it open-ended, like you just token after token after token? Is it closed-ended? What is your corporate governance, right? What are the rules that you have in place to ensure token owners are not taken advantage of, right? Because so many people that issue cryptocurrency, they don't even think about this. It's not even on their radar, right? I've had so many due diligence calls with these guys, with projects, and you start asking questions about governance and token models, and you literally, the glazed look on their eye is they're like, they don't even know what I'm talking about. So that's also really important. And then there's other things in terms of how do you value the token, and that's a very, very long conversation, that we can have for another time, because there's a number of different methods that people use depending upon what the token is and what it's being used for. How do you value Bitcoin versus, let's say, a fund fair, versus a Zcash and things like that.
That's great. All right. Thank you, man. I always love chatting stocks and markets, and now I'm learning to talk cryptos with you, so I appreciate it. I'll have you on soon. Thanks, buddy.
Thanks for everything.
Well, I hope you enjoyed listening to Barry. He is a world-class analyst. He is. It's always a joy to speak to him. He's a better person than he is analyst. He's a really, really solid guy. A good friend of mine. I'll have him on here occasionally. When I see stuff like what's going on in Italy, he's my go-to on macro financial services related and how it could spread type of stuff. He's smart. I hope you enjoyed it. And I'm learning from him on the crypto stuff. I think, he's doing this newsletter, and, he brings that same kind of analysis and thought to his newsletter. So thanks for listening. And next week, we are going to have a guest you will all be familiar with, but I'll wait to let you know. Maybe I'll tease you during the week. I'm not sure. But anyway, hope you have a good week. Thanks for listening.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.